Hello everyone, welcome to yet another video of job interview series of GMT Academy. So in this video, we are going to discuss couple of questions related to capital market. So the first question is, what is the difference between debt and equity? Okay, so first, what is a debt? So debt is a company's liability, right? So which must be paid after specific period of time. So it is a kind of liability which which company has to repay after over the period of time along with interest, right? So on the other hand side, the money which is raised by the company by issuing equity shares to public or its investors, which can be used for a longer period of time, is called equity. Now the debt holders are outsiders, okay, because it is a kind of loan which is taken from the outsider. However, the equity holders are the real owners of the company. Okay. Then debt is borrowed fund, while equity is owned fund, which owned fund in the sense which can be used for the longer period of time. The debt reflects money owned by the company towards another person or the financial institution, and equity reflects the capital owned by the company itself. Right. Now, date can be kept for a limited or predetermined or fixed duration. However, it should be repaid after expiry of term. I mean, there is a specific maturity date is there. Okay, so you'll have to repay that capital, or we'll have to repay that capital after on the at the time of maturity, or on a certain period of time. There is a fixed duration which is predetermined duration. So at the time of maturity, company has to pay interest along with the principal. But when it comes to the equity, that capital can be used for a longer period of time. Now, the debt holders are the creditors, whereas the equity holders are the owners of the company, right? Debt carries a low risk as compared to equity, and when it comes to the returning, it is vice versa. Now we'll see that in the next point. Okay, so debt can be in the forms of term loans, debentures, and on the other hand side, the equity can be in the forms of shares or stocks only. Now, returns on the debt is known as interest. However, in the contrast, the equity returns on the equity is called a dividend. Okay, so dividend is a profit. It is a share of profit which is distributed amongst the shareholders. Right now, the returns on the debt is fixed and regular, irrespective whether company is going to make a profit or a loss. Company has to pay interest on the debt. Okay, so when it comes to the equity, it is not compulsory that company has to pay dividend every year. So it depends upon the company whether it company is going to make a profit or loss, or company wants to declare the dividend on that particular year or not. It is completely depend upon company. But when it comes to the debt, company has to pay the fixed and the regular interest on the date. Okay, or that that term loan whatever has taken. Now debt can be secured, unsecured. However, the equity is always unsecured. That means debt security, some securities are backed by the collaterals, right? So there is a kind of a guarantee, and that's the reason certain dates are secured and some of them are unsecured. However, equity is always unsecured. Just keep that in mind. Okay, so these are the major point which differentiates debt and equity. Now let's move on to the next question. What are the two types of capital market? So there are two types of capital market. One is primary capital market and secondary capital market. In the primary capital market, what exactly happens? In the primary market, the first time the security is sold by the company, it is a kind of initial public offering, right? So it is the first time when company is selling that securities to the in the market, right, to the investors. However, On the other hand side, the secondary market is where the existing securities are traded. That means once the initial public offer, I mean IPO is listed on the exchange, then that security is easily available for the trading, right? So existing securities are traded in the secondary market. Now, excuse me. Now the next um, major difference in the primary and secondary market is, in the primary market the company sells to the investors. The security is sold by company directly to its investors. However, in the secondary market, one investor sell the security to another investor. Again, primary in the primary market, the company fixes the price. Initially, company fixed the price at the time of IPO. However, in the secondary market, the market determines the price. That means the demand and supply determines the price in the secondary market. Okay, the main purpose of initiating this capital in the primary capital market, the fund is raised for the long period of time. However, in the secondary market, it provides the liquidity. Okay, so these are the major differences between capital market and secondary market. All right. Okay, so let's move on to the next question. Next question is, what are the instruments of the capital market? Okay, so we have pretty much covered most of the points in the first question itself. But when this specific question is being asked in the interview, what are the instruments of the capital market? Then specifically we can say, in the equity market, okay, so in the capital market is broadly classified into two. One is equity security and debt security. In the equity security, further divided into, there are two types of instrument. One is equity and preference shares, means ordinary shares and preference shares. And in the debt security, it includes bonds and debentures, right? So these are the two major instruments traded in the capital market. Okay, let's move on to the next question. When should company buy back stock? Now, when company buybacks their stock mainly to create a value for their shareholders, means sometimes company feels that their stocks are undervalued, and in order to gain the confidence of the shareholders, okay, the value means, in this case, create a value means rising share prices and paying premium value for the shares. That means when company is buying back those shares are bought at a premium price. So for example, the market price of the security is 100, then company will buy back those shares at a premium price, let's say 110. So that gives a confidence to the shareholders. So what are the reasons for buyback of stock? So first is excess of cash flow with the company. So company is doing great, and company is into profit, and company that gives a confidence that in the future company's future is bright. And that's the reason that excess cash or cash flow can be utilized to redeem those shares, right? Second, another reason is tax perspective. Also, some companies will buy back those shares from the shareholders, right? Buyback of the shares tend to improve the value of the companies, right? So it is a signal that company is performing very well, and it is going to further make a good progress, and that is a good indicator. And that's the reason company is having a sign that the stock is undervalued, and company will, to in order to boost the confidence of the shareholders, they will buy back those shares. Okay, so these are the various reasons which can be explained in the interview. Okay, now let's move on to the next question. Explain the term over the counter market. Now, what is over the counter market? So term used to describe the decentralized market with no physical location. I mean, just like we have a stock exchange like BSC, Bombay Stock Exchange, National Stock Exchange, but here in this case, there is no physical location as such. So in this market, traders or participants trade with each other using various communication modes such as telephone, emails, or proprietary electronic trading system. So that is independent trading, platform which can be utilized to communicate with each other. All right. So there is no physical location is present in this over the counter market. All right, so that's all for today in this video. So please like, subscribe this YouTube channel, and do not forget to share this video with your friends. Thank you.